Well, good morning, everybody. Welcome to the Locking Your Success Options Trading for Income Weekly Update for June 23rd, 2014. Before we get going, I'd like to remind you that this is for educational purposes only. We're not broker-dealers or financial advisors, and we're not making any specific trader recommendations. Also, please note that the risk in trading options can be substantial, so please be aware of all your risks prior to placing any trades, and that we are using hypothetical computer simulated performance trades, and therefore the actual results may vary. Before we get into anything here, just going to let you know I'm going to be in Los Angeles next week, so there's not going to be a live update on Monday. I'm going to do the best I can to either post a short recording or some sort of a static post to the position update, so that to keep you guys informed. But it's going to kind of depend on what time my classes get out on Sunday night and what kind of internet connection I actually happen to have. So just keep that in mind, and we'll be back to our normal schedule on Monday the 7th. All right, so if you're watching this, continuing on, if you watch this on YouTube or some other venue, please come on over to our website at lockingyoursuccess.com. Check out our programs, the M3 Bearish Butterfly ROCK M21 Group Coaching and Trading Triangle program. Also, join our mailing list, the 7 Secrets to Becoming a Successful Trader, and sign up for our free weekly webinar. And also stay tuned for our programs currently under development. All right, so let's take a look at the markets. If you remember last week, I was saying it was a pretty easy call that we're going to be up for the week. I was thinking that we're going to expire somewhere in this little oval here. We came right up into the top end of the oval for expiration day on Thursday, bounced a little bit higher on Friday. So the market did pretty much what we expected last week. This week's a little bit more complicated to determine where the market's going. What we have going on is we had the Russell, which broke higher last week, which would imply that we're going to go higher this week. We have the SPX, also broke higher into new highs last week, again implying we're going to go higher. We have the NASDAQ, which failed to break out last week, so that's kind of neutral. Or at a decision point where we don't know which way the market's going. And we have the Dow, which is basically in the same condition as the NASDAQ, where it kind of came up, couldn't break out last week. So that's at a decision point. So we have 2 bullish indices. We have 2 indices that are at a decision point. And if you look, it's a little bit reflected in the futures, where the Dow's up 0.2% already, the ES is up a little bit, and the NASDAQ's actually down. So depending on what happens in the Dow and the NASDAQ is going to kind of give us a direction for at least early in the week. I think that the Russell path of least resistance is to continue to go higher. I still think we're going to at least 12, probably at least 1,200. I base that off of the shorter term pattern, and I think there's a very high likelihood we go to 1215 before we turn around and come back down. Not saying that's going to happen this week, but I believe that's going to be the general path of the market, is a move up to around the 1200, 1215 area, and then there's some sort of retracement, probably about 50 points, probably back down into this support level here at 1175 over the next couple weeks. So that's what I would be thinking. Of course, we can always turn at any time. Bad news will advance that a little bit, but barring any bad news, that's what I would expect of the markets. All right, let's take a look at what's going on with the trades. We entered a lot of stuff last week, and we closed let's look at this. I closed the V trade as expected last week. I just kind of let it expire for a profit of 26.66, 5.3% return on planned capital. So for the year, that trade's up 20%. We went over the rest of these last week. Everything's pretty much right on schedule for the year, except for the V trade, which is a little behind schedule. It's been having a little bit of a tough time in the volatility, which is fairly normal for this type of a trade. The Bearish Butterfly tends to like the volatility. M3 tends to like the volatility, and the ROCK trade can go either way. So everything is right on track here for our projected returns of about 140 on a Bearish Butterfly The M3 is actually a little bit ahead of normal, and about 120 on a rock trade. So everything's going well. And again, the V trade's a little behind schedule here. It should be up at around 30% by now this year. So that is all the closed trades for June. As far as July goes, things are not going so well in July for the July V Condor. They're not going terrible, but they're not going really well either. We have had that really, really large up move since this has been on. I think it's been over 100 points. And it's definitely showing this stressed out from the upside. This is what the position currently is. Let me go back and take a look at where we were beginning of the week. So Monday we're sitting here short 12 of the 1,200 options. And other than that, that's the only adjustments that we've done to the position is buying back these short calls. This is what we look like here. And we've already withstood quite a large up move. It's down about $1,000. I believe on Fukar T-Log on the 18th, which I believe is Wednesday, I bought back another one of these 1,200 calls. And then on the 20th, I made more of a major adjustment. So I'll explain that to you guys in a minute. If we go to the 18th, we had hit our maximum delta limits. I ended up buying back this 1,200 call. Ended up being drawn down about 2,700. We have a maximum loss on this of, if it gets down about 5,000, I'm going to start shutting it down. So, as of right now, we're a little bit more than halfway to maximum loss. This is what we looked like on the end of the day Wednesday. And then on Friday, of course, we got this continued up move. So usually what we do with a V Condor when we get this continued up move is we'll buy back this spread here. We'll roll it back 20 points. We'll take the downside and we'll roll it up to a point where we get a decent amount of credit. So in this case here, it would have had to been, I mean, realistically up in the, the 1070, 1080 level, and then we normally move the straddle. I analyzed doing that. I didn't like it. Part of the thing about doing a trade like this is you don't want to take on too much price movement risk, and making that move took on more price movement risk than I wanted. So as an alternative, I think I'm better off, at least from a safety standpoint, to just leave the shorts where they are. So I left these where they were, and I only moved up our lower spreads. So what I did is I took those, let me just look at my notes here so I can tell you the accurate thing. I took those lower spreads, I rolled them from the shorts of 990 all the way to 1070. And then to reduce my downside risk, I took this call and I rolled it up to, what did I roll it to? I think 1160. I took this 1090 call, rolled it to 1160. I ended up buying back one of these 1200s. So if you look at that as of end of day Friday, I only have 10 of these shorts here at 1200 now. I rolled my long call to 1160. I took my short puts, well, this whole spread actually, and rolled that all the way up to 1070. This gives me, the market backs off. It gives me a lot of range before I really get into trouble. That's come all the way back down to 1130, which is a pretty good size move, definitely more than a standard deviation for the time the trade's going to be open. And if the market settles, I still have this theta gain. I could get the money back. If the market goes up relatively quickly, I can't get down more than, what's this showing me here? I mean, maybe a little bit worse than this, but it brings me right down to about my maximum loss if we get a large up move, in which case we'll just close the position and move on in the next month. But barring any really big move up, this should be okay. Unfortunately, I do think we are going to get a big move up, so I think there is a relatively decent chance that this actually loses this month in this configuration. I could be more aggressive and save it if I wanted to, but that would be taking on a little more price movement risk. As a trader, I could choose to do that. The way I'm demonstrating this trade and having it for beginners, I just assume not do that. I just assume keep it mild, keep the drawdowns low, and just let the thing loose. If the market continues to go up, I mean, I'll try and fight it, but I'm going to fight it in a safe manner, where I'm willing to take a small profit or a break even, rather than taking on this whole bunch of price movement risk and then having a problem with it. So that is how the V Condor is going. The next trade we have open would be our July Bearish Butterfly. And being a Bearish Butterfly does not like this very large up move either. Let's go back to Monday. Since this has been on, so let's see, the trade's been on, I don't know, it's about almost 30 days. And since that's happened, we withstood most of this very large price movement here. So obviously, being a Bearish Butterfly, it's going to be drawn down a little bit. As of, let me see if I can find it here. So as of Monday morning, this is what our position looked like. We were 3/3 scaled in. We had a hard roll point at 1180. We hit that roll point on Wednesday with a fairly aggressive up move last week. So if you come to the end of Wednesday and we let this thing update, what I did is I rolled the butterfly. It was down here at 1140 up to 1200 as per guidelines. That left us in a position that looked like this. We're now down 5,000 or 1/3 of our maximum loss. So we still have the trade's not in any trouble whatsoever. And there were no further adjustments going forward, and if you bring this till Friday, we actually gained back some of those losses, even though the market continues to go up. And it was looking like it's down about $4,000. So here we are, a very high theta position. Realistically, if the market grinds at 1210, 1215, and it stays there, then this trade should do okay. It's going to draw down a little bit more if that happens, but it should be able to take that all right. If it's a very harsh move, it might draw down a little bit close to maximum loss. We'll have to see. And we're a little bit vulnerable to a very large down move, but otherwise everything's looking fine. So I mean, we've stood, like I said, it's been 100 points up. So that's a pretty big move in the last 30 days, and that's keeping us active on this. This is a high theta price trade that does take on some price movement risk, so this is pretty much normal. At this point, I'm looking for a $5,000 gain. Exit the trade, move on. The good part about this move, though, is it sets us up very, very nicely for a August Bearish Butterfly, which we'll take a look at in a little bit. All right, so that's what's going on with that. Let's go to our July M3 trade. I'll close this out. Bring this back to Monday. Let's change our accounts. This is what we had going on Monday for a July M3 trade. Very nice looking trade, actually. Nice flat T+0 line. Plenty of downside room, and that's looking really nice. Minus 28 delta. Can't ask for better than that. So going forward here, of course, we had an up movement in the market. Let's take a look at our T-log on the 17th, which is Tuesday. Did a very, very minor adjustment. If you remember right, when I get outside the 10, I like to start adjusting this at minus 50 delta. And that's what I did. So on Tuesday, I came in, did one vertical, 1130, 1140 put vertical. Essentially rolled one of these up to these 12 up to 1140. On Thursday, the market continued up. I just did another very minor adjustment where I took an 1130 to 1150, and then on Thursday, with a continued up move, got a little bit more aggressive here and did 5 1140, 1150 puts. And that's going to leave us in the position I'll show you on Friday, which is where I have 4 shorts at 1140. I have 6 at 1150. I have a delta of about minus 43 as of 3:30, which is perfect. Our position is up slightly, and if we look at our analyzed graph, here's what we're looking like. This is still looking very nice. I do have a suggested roll point at 1190 where should be rolling the butterflies up. I might let it hang there for a day or two, see if it's going to come down if we get an up move today. If we get a big up move, then I'll roll it. But if we get a small up move and just kind of hang around the 1190 area, I might add another vertical and wait it out. But this is what the position looks like. Right now, we're set up really well. If this thing, does a normal retracement, comes back 30 or 40 points, this will be making for a good trade. And if it shoots up, it's not a big deal either. So all's looking good with this position so far. We still have, 28 days left or something for the market to retrace for us. And that is the July M3. And that's all the stuff that we actually had opened. Let's take a look at the new trades that were initiated. So our July ROCK trade, the entry test is still putting us, even though volatility is low, even though we're in a grinding up market, the entry tests are still putting us into an M3 position on entry. So that's what we did. If I come back to Wednesday, I'll show you how I initiated this position. So I decided to come in well behind the market. The market's at 1181. I decided to come in 40 points under at 1140. I added 3 1140, 1150 verticals, 7 1140, 1170s. Put myself minus 18 delta, and I put 1 1100 call in. So this is what the position looks like on entry. Again, a really nice, fine-looking M3 type of a trade. From here, if the market doesn't go up, this is essentially going to be traded out as an M3. If we do start shooting up over 1200, which I do expect to do, I'm fairly sure, depending on how quickly it happens, but I'm pretty sure this is going to allow us to go into a regular ROCK trade, which I'll probably enter at 1180, 1220. And then scale into the 1240s if the market goes up. So, as of right now, we're in the M3, and I'm looking for a move to about clear move over 1200 end of day to get into a more aggressive ROCK type of position. So that's the ROCK trade. If you go to the end of the week, there were no adjustments. The position is up $336. And that's what we look like by end of week. And let's see what else. We had to open up an August V Condor, and we did that on Friday as well after our expiration of our June. Let's just go do that. I'll show you what position I'm in there. I ended up selling our shorts at 1270 for the calls. Sold the 1090 puts for the shorts. I did a straddle at 1180 here and here. This is what our T-log looks like for that entry. And our analyzed graph actually looks very, very nice for this. Looks like this here. It's a nice wide position considering the lower volatility levels. And we're all already overextended, so a move to 1215 here isn't going to be that big of a deal for us. This line will rise relatively quickly. And, if we back down into this range here, this should be a good trade for the month. I kind of like it. The only downfall is we get a really, really harsh down move. Then we're going to be fighting this thing to the downside. But that looks nice. And the last trade we got going on was the August Bearish Butterfly, which I really, really like this trade this month. I entered at the 1160 strikes, which is 26 points behind the market. Had a delta of minus 102, a price of about 1076, theta of about 99. So a little bit higher than I'd like, but nonetheless, beautiful, beautiful entry this month with the market up over 100 points off the bottom in the last 30 days. This is makes for a fantastic entry. If the market runs up to the 1210, 1215 area, backs off, does a normal retracement, this will be a really nice and easy trade this month. If we run to 1140, it'll be 1240. It'll be a little more difficult, but still should be very, very manageable. So very low risk, great entry trade this month that I really like. And that's all I have for the trades. And yes, I have a question. Did I open it on the call side? Yeah, and that was an accident. So I accidentally did enter this trade on the call side. Synthetically, it does not matter. I meant to do a put side butterfly, but like I said, it really doesn't matter. If the price goes up a lot, it might be a little more difficult to get out of. But that's what we're looking like there. And let me just show you the analyzed graph for this. So that this is a nice looking trade. All right, yeah. So yeah, I've got like 3 questions about entering on the call side. So that was an error. We will play out the error. We'll let it go. Next question, and if anybody has any questions, please just put them in. And I have a couple going already, so just type them in, and I'll do my best to answer them for you. All right, so going forward, would I change my roll strategy from the guidelines on the July bearish butterfly? No. I think the strategy is perfectly fine. I cannot. Let's see if I go to our July bearish butterfly. Right now, my guidelines tell me I cannot make a roll until 1200, and when I do exceed 1200 towards the end of the day, it might be a little bit sooner because I am coming on 21 days to expiration. So by the time I actually talk to you, by the time next week comes along, we will be under 21 days to expiration. Not a bad idea to start keeping in mind our delta theta guidelines. But our maximum delta guidelines for 21 days to expiration. So this wouldn't be a bad idea. Coming into expiration, maybe starting to limit our delta a little bit with an upside move. So in other words, normally I'm not adjusting this till I'm over 1200. So say I'm 1205, I'd roll my 1160s up to 1220. Because we're getting close to 21 days to expiration, not a bad idea, and the volatility is low, not a bad idea to transition into those expiration guidelines and start peeling off some of these 1160s before we actually hit 1200 to keep our delta reduced a little bit if our delta gets up in the up over the 500 range. So cutting delta, I think is a decent idea. So that's one strategy. What's one minor change I might make to my adjustment guidelines is just transitioning into expiration. But as far as breaking for a bearish butterfly, this is usually a good position in this type of a move. So everything is fine. All right. So if I want to scale into a trade without being at the computer, how do I calculate my limit orders for, let's say, scaling into a ROCK trade? Well, if it was a bearish butterfly trade, it would be very, very easy because essentially you don't really care whether you hit the, if you're scaling into a bearish butterfly trade, so for August, that would be really easy because I don't really care if I get entered into my 1180s at exactly 1180. I mean, it's fine if the market goes all the way to 12. I mean, it's fine if the market exceeds my adjustment point by like 20 points because it only makes it cheaper to do my adjustment. If I'm doing a ROCK trade and I'm trying to get in front of the market, then I can scale in with automatic orders. But what I would rather do is limit my delta with calls. Like if I didn't want to do stuff intraday, it depends on, if your question is, are you going to be at the computer sometime during the day? Or are you going to be in the next day or two? If I'm going to be at I'm going to be away in LA next week, right? So if I want to scale into, if I'm in a ROCK position, I want to scale into it. I may not want to add butterflies in front of the market automatically because I really have no idea of where pricing is going to be. So what I can do instead is I can limit my delta with calls. I can pick my delta points, and when I get to whatever delta level, I can limit my delta with calls, put calls in there, and then the next day when I'm available at the market, I can sell those calls. I can buy. I can negotiate and buy those butterflies, and essentially be in the same position. So I can temporarily correct my delta issue, then come in and then do the butterflies later. Or my other option is to put a, if you have thinkorswim, you can put a contingent order in, you can try to buy the butterflies at a certain price if you have an idea what pricing is going to be. And if that doesn't go, you can finally do a one order cancels other, buy a call, and dump out of the butterfly, that type of thing. So you can be a little bit creative there. But if I would rather do automatic adjustments in a rock position when I'm trying to buy ahead of the market that's going up, I'd rather try and price the butterflies properly and so do a call automatically and price the butterflies properly later, then come back. But you can put the orders in. It's just like I said, you may or may not get filled. It's going to be a tough go at it. All right. Let's see, time here. It's almost 9:30. All right. So when I want to see the volatility to track the trade, you see the IV at the bottom of the TOS graph or the RVX index. Okay. Alexis, I'm not sure of your question. When I want to see the volatility, all right, so I'm going to assume that you mean the volatility of the trade where it currently is. So if I want to know the volatility of my trade right now at this price level at this time, yeah, I mean, I can just look at my option view here, and I'm minus 47 Vega. So if that's what you mean, that's how I'm tracking the volatility of my trade. If I'm tracking the volatility of the market, I mean, I don't really care what the volatility of the market is. I care what my skews are in my T+0 line or how my T+0 line changes with price moves and stuff. That's not always reflected in the market as we see now, because right now the market volatility is very low, yet the rock trade keeps putting us in M3 because the delta is telling us that that's the thing to do. So that's what I'm thinking there. Okay, so let's see. Okay, how can I analyze a trade that combines Russell and IWM? Right, so this is an excellent question that I get all the time, and it would be very nice if OptionView would allow you to do that, but they don't. So all I do is I multiply everything by 10 and put everything in the Russell. So if I have this July M3 trade on, if this could represent a single Russell butterfly at 11:30 with 4 11:30, 11:40 IWM put spreads and 6 11:30, 11:50 IWM put spreads and 1 106 IWM call. So this could be a $5,000 position mixed with Russell and IWM. My Greeks are going to be the same, or close enough that it's not really going to matter. So then I would divide everything by 10. I'd actually have -5 delta. I'd actually have a profit of $8.30, and I'd have to have a theta of 5.7 and a vega of -3.5. So this is how I would track that. You can match the Russell pricing. In other words, I wouldn't count on this for your exact profit and loss number. I'm more using it to analyze the Greeks than analyze my profit and loss. I'd watch my profit and loss in thinkorswim. If I needed a profit and loss adjustment, I would just go into my T-log, make a minor adjustment on one of these options to get my profit and loss close so that I'm getting a screen that looks close to what I have. Monitor the Greeks here, monitor my profit and loss with my broker, and that's the way I do it. So hopefully that makes sense to everybody. On a July bearish butterfly, would I ever have some 12-20 strikes going at the same time my 11 60 strikes as you're transitioning to the trade to the up move. Yeah. So you have to decide when you're scaling, when you're going to roll your butterfly, you need to decide whether you want to buy a butterfly first or remove a butterfly first during your roll. And certainly if I think the market's blowing off, I wouldn't mind adding in my 1220s and then scaling out of my 1160s, or if I'm timing the market a little bit, I'd run up and time it, and then when the market pulls back a little bit, you can get out of your other butterflies. You can do more efficient rolling that way. Certainly, if I had a really, really big position, if I have 100 lot bearish butterfly on, I'll be doing that gradually. So I'll be buying some 1220s. I'll be selling some 1160s. I'll be buying some. And I'm not going to try and pick up and move 100 butterflies at once. I might be scaling into those, scaling out of the lower ones a little bit early, and then as the market continues to go up, scale into the higher ones, and gradually transition. So yeah, so we would ever do that. We would do that. Okay, so this is back to the automatic scale-in, and it says so buy stop orders on calls at a certain level. Slippage could kill me. Well, yeah, you're in Canada, so you're dealing with some. One of the things you're dealing with up there, I think, is you have a ticket charge, which is a pain in the neck on your call. So you got to watch your execution there. But yeah, if you're buying orders on calls, you would put them in at. Well, I don't know if your broker will allow you to do this. Or Thinkorswim in the U.S. allows you to put in orders based off of mid prices. So I'll put in a cascade of orders. So if I know I want to buy a call at 1191, I can put in a call to buy a certain call when the Russell hits 1191 at mid price, which it'll either fill or it won't, depending on whether there's an order in there already. Because when you put an order in for a call, you affect the mid price because it usually tightens it unless somebody else already has an order in. So you don't know if you're going to get filled at mid price, or you have to get filled somewhere between mid price and ask, or sometimes you can get filled just even below mid price, depend on what's going on there. Because if somebody has an order in and has narrowed that spread, you can come in below mid price and it'll fill. So you don't know, and that's the drawback of not being at the screen and not knowing this stuff. So you can come in and you put the order in at mid price, and Thinkorswim allows you to put a one cancels other order in. So you put a call order in at mid price, and then you let the market go another dollar. If the call doesn't fill at mid price, you put in an order to fill the call at mid price plus so many cents, or maybe 10 cents or 20 cents. Again, the slippage there isn't too bad. And then if you put another order, if it goes up another dollar, you just buy it at mid price plus 20 cents, and one of those will come in. All it's going to take is the market to fluctuate down a little bit, and it should get filled at that point. So yeah, I mean, of course, you have the option of leaving it until you get to the computer. And taking as much pain as you can in doing that too. But if you're going to do, with a bearish butterfly M3, you don't typically have that problem. A rock trade requires a little bit. I mean, there's more money to make, but it requires a little bit more maintenance as far as computer time in certain circumstances. If I'm in a rock trade in an M3, it doesn't require any real monitoring per se, like an M3 doesn't really require a whole lot. If I'm in, in a regular rock position and I'm 2/3 scaled in or something, and the market starts really taking off, then it's a little bit more important, especially to the upside, that you do something with that. So it's not something you'd have to do all the time, but it is something that you would have to do occasionally. You just have to take the slippage in that case. All right, I think that's all I have for questions. I thank everybody for joining me today. And like I said, I'm going to post you something next week. I'm not sure how extensive it'll be yet, and we'll be back to normal on the following Monday. So everybody have an awesome week, and we'll see you in a couple weeks.